Hey everyone, it's Jana Stafford with BIC Magazine, and today I'm joined by Dr. Dean Foreman, who is the Chief Economist with American Petroleum Institute. I know Dr. Foreman and others at API have consistently said if economic growth were to stay on the same track it has been, the world would likely need more oil to meet the demand. So, Dr. Foreman is here to discuss those projections and to catch us up on what has happened with U.S. petroleum since we had him on last. Welcome, Dr. Foreman, and thank you for your time today.
Yeah, it's great to see you again. Thanks so much
Yay.
for having me.
You too. You're welcome. Well, let's start off with the demand for petroleum throughout the month of December, especially considering the ongoing supply chain issues and the holiday travel season. So, has the onset of the Omicron COVID variant had any effect on the demand for oil, including the oils refining and petrochems make that are needed for medical plastics and sterile packaging?
Great question. And it's actually maybe not the response that most people would expect, because you'd think, okay, you're shutting people in, maybe demand's going down. And it actually had the opposite effect. So you had relatively more driving instead of flying. You had, with the shift towards online retailing, more diesel fuel and freight shipping of goods. And then for materials, as you mentioned, whether it's medical plastics, sterile packaging, a lot of the petrochemical sector that takes oil. And keep in mind for the US, we're talking upwards of 30% of total US oil demand is related to materials. Intermediate goods, naphtha, gas oil that feed the refining and petrochemical sectors, that hit an all-time high in December. It's just remarkable how it's continued. So with that, and it's important to put this in a global context, US demand was higher in December than it was at the same point in 2019. Global demand, according to the US Energy Information Administration, was back above 101 million barrels per day, again, above where it was in 2019. And they're projecting that it'll grow to more than 103 million barrels per day to exit 2023, so for the next 2 years. With this, it just says what we learned through COVID and what we continue to see is that the economy and the demand for oil and natural gas are highly intertwined.
Okay. Well, let's talk about the production of U.S. crude oil and natural gas liquids. How has that been shaping up as of late?
That's been the pinch point, and it's where market tightness has been a continued concern. API, we're a primary data source, right? So when I'm giving you numbers on U.S. petroleum supply and demand, trade inventories, we survey up to 90% of the industry every week, along with EIA, and we're 2 months ahead of EIA in putting out these monthly estimates. So on the supply side, what we've seen is it's actually backslid a little bit in January, and it's ranged over the last quarter, the last 3 to 4 months here, between 11.3 and as high as 11.8 million barrels per day in any given week, at another 5.5 million barrels per day, roughly, of natural gas liquids. It's been range bound, though, historically, and that's been happening because for 20 to 30% of the well completions by EIA's estimates were relying on previously drilled but uncompleted wells. Our drilling activity in December, if we're comparing back to the same point in 2019, is still substantially down. So if we're going to get 2019 and early 2020, really high production levels like we saw, and to give you a high water mark for US oil production would be like 13.1 million barrels per day. And by contrast, the latest week's 11.7. So we're still down the better part of 1.5 million barrels per day on the oil side. Natural gas has held up relatively better, but net, if we're going to grow, that dearth of domestic production really goes through the entire value chain. It affects relative values domestically versus internationally, and it really has been what's changed the pulse of our industry.
Okay, well, I know we're certainly feeling it at the pump, aren't we? I know there are high stakes for U.S. investment, trade, and economic activity across the value chain. So can you talk to us some about the export of U.S. refined products?
So let's take exports first of crude oil and then of refined products. Let's do both. And, it's this combination of workforce, supply chain, financial and energy policy issues that's held that supply back that we were talking about just now. With that, if refiners are going to meet domestic demand, what they've had to do is draw upon the existing inventories of crude oil, right? And those are now drawn down below their 5-year range. In addition to that, they're also importing more. So we've imported more crude oil than we have historically here, or at least in the last recent years here. So our net crude oil imports are above 4 million barrels per day. On the refined product side, this is something new we haven't actually seen until December so much, is a very large drop off in refined product exports from the United States, despite the fact, as we were just talking about, that global demand for refined products and oil is back above 101 million barrels per day. So that tells us that the US has lost some competitiveness here by not having the domestic production. And we see it in the prices every day. So it's not just the price at the pump, which relates strongly to crude oil historically. It's the fact that the relative prices between domestic and international crude oil have been within, we've had days where it's been 30 and 60 cents per barrel. It doesn't even cover the cost of transportation between the two. Compare that to 2019, where we had discounts of domestic crude oil of $5 and $7 per barrel compared to just cents on the barrel. That makes a massive difference in terms of competitiveness. And at the same time, as natural gas costs have also gone up this year. I mean, domestically, we're concerned when we see $4 to $6 per million BTU natural gas. That affects the refining competitiveness because natural gas is the main processing fuel for the refinery sector. And internationally, by the way, we've just had an energy crisis in Europe that's continuing to play out, where we have natural gas prices above $20 per million BTU. And in recent months, a whole quarter actually over 30. It's unprecedented. We've never seen prices this high, this long internationally.
Wow. Well, how has the current domestic oil production affected the U.S. refining industry and perhaps even large capital projects?
I mean, that is the great question, bottom line for all of this, right? So the natural gas as a process fuel definitely raises operational costs and is another headwind in terms of international competitiveness for the refining sector. If you're going to invest in US refining, though, expanding, whether it's refineries or integrated petrochemical facilities, let's start with the advantages, the comparative advantages for US refining and petrochemicals. They've got the best workforce in the world. They've got really good scale, especially along the US Gulf Coast, good infrastructure supplying all of that. So all of those things are advantages, but the headwinds here are, again, not having as much of an advantage feedstock in either the crude oil or the natural gas side. So the combination of those, if you take those inherent advantages in terms of workforce and infrastructure and scale and combine an advantage feedstock, that's why the US has been able to grow as a preferred provider of refined products to the rest of the world. And now it's really backslid. I mean, we're down in the last couple of weeks, a couple million barrels per day, literally, in terms of refined product exports. If that were to continue, and a couple of data points doesn't necessarily make for a trend, if that continues, that really upends the economic relationship and the incentives for investing through the value chain in the US. So it's really important that trade policy, energy policy be coherent, cogent, and support this huge source of energy through the US value chain that frankly has a pulse on price inflation and everything else across goods and services in America.
Yes, that is a lot. But what might the market demand fundamentals tell us about this year?
Well, point one is the prospect for market tightness, in the sense that historically, if you have a combination of demand outstripping supply, lower inventories, more dependence on imports, historically, that's been a recipe for upward pressure on prices. No question about it. The next thing is that, if you've got a tighter global market, especially for oil, and you have it for gas right now, geopolitics and the exposure to those in terms of just price volatility as American consumers, we've been largely insulated from this for 5 or 10 years, thanks to the US energy revolution. And that changes in a tighter market. There's no question about it. So, when you've got an administration that, when we need more domestic crude oil production, is turning instead and asking OPEC to increase more. When we need more natural gas internationally, goes to Qatar and asks the Qataris to increase their natural gas production, rather than work with US industry and put policies in place that would support that. Ultimately, this is contributing to upward pressure on prices.
Okay, well, for some time, you've been of the view that price inflation could take considerable time to ease. Why is this?
So let's start with where price inflation stands. In December, per the Bureau of Labor Statistics, we had price inflation year on year 7.1%. with the average American household spending over $61,000 a year, that translates to, well, over $350 per month per household. And I got news for you. 40% of US households don't have an extra $350 a month of discretionary income to just throw at this. And, when it's energy costs going up, it's in your face, right? It's hard to substitute away. You have to drive to get to work, get the kids to school, whatever it is, it's part of your daily routine. When food and other things are going up, though, food, to some extent, you can substitute one kind of food for another, maybe not spend as much, maybe shop somewhere else. There's some substitution ability because the essentiality gives you more options there. But housing's up as well, and semiconductors and automotives and healthcare and everything else. And, the semiconductors and automotives have been actually mentioned explicitly by the Federal Reserve Bank as reasons why they would expect price inflation in 2022 to recede a bit. And the objective, or excuse me, the rationale they've offered is that supply chains would clear up a bit, that some of the demand and supply would integrate better, and the just-in-time manufacturing that's been disrupted would flow better, and that this would result in some easing of price pressures. But both of these industries, semiconductors and automotives, have discovered that they have pricing power, for one thing. Two, when it comes to the semiconductors, the things that have been in short supply, or the shortest supply, have been the older generation of chips that go into autos. And in this case, a lot of the manufacturing capacity during the 2020 COVID-19 recession was taken down. So it's kind of like going out right now and trying to find an incandescent light bulb. You can't go to Home Depot and find one on the shelf, right? You can't, likewise, when they've stopped making some of these older chips, you can't go and just procure it. So you've had auto manufacturers hoard as much of a supply of these chips as they could for a while. And now they're just making millions fewer of internal combustion engine vehicles, or vehicles that require these older generation of chips. And people point to Arizona as, okay, there'll be a new chip factory that starts up in the next year, right? One, it takes time. Two, it'll produce newer chips, not older chips. And the autos, the chip manufacturers actually asked the auto industry to shift to newer generation of chips for years here, and that hasn't happened. Maybe it'll happen, but if it does, it'll add cost. And this is the issue in an auto industry that, just like the energy industry, when you have a transition and you're spreading a relatively fixed pool of capital over many more proverbial mouths to feed here, so a lot more sources of potential recipients of this investment, it becomes hard. And it's hard to see those prices receding quickly for these kinds of reasons. And that flows through lots of different value chains and lots of different industries, where the more you talk about a transition, you're talking about changing out capital. And it takes time. It's very capital intensive. And most of these things have been underestimated. In our industry, in oil and natural gas, we see it. We see how long it takes. Again, workforce and supply chain issues where there's only such a depth of skilled labor in certain areas. When we have supply chain issues like getting lines or line pipe or valves through a congested port and then trucking them to an area that might be remote, where there's production, those have been issues. Financial issues with the amount of debt that the industry took on, and capital availability continues to be an issue. And now we have energy policy headwinds on top of this. So if we take the administration's day one opposition of pulling the environmental permit on the Keystone XL pipeline, the opposition to the Dakota Access Pipeline, which is in service, but has been threatened with its environmental permit. We have a clean energy power plan that's been proposed that would all but eliminate natural gas in the power sector in the United States, despite the fact that in 2020 it achieved a record 40% of US electricity net generation. We've had a moratorium on leasing on federal lands. And then when they repealed that, or were forced by the courts to go back and resume leasing, they've made it more arduous. They've also proposed higher taxes on the energy industry very selectively. So you add all this up, and it really is a headwind to investing in US production here at home, when having domestic production really is the solution to so many of the price pressures that we're seeing on the energy side. The logic is clear. The imperative is clear, and the ability is here at home. It's just a question of getting the right minds together to really make it happen.
That is true. So are you bearish then on the prospects for economic growth this year?
Well, that's the thing. I mean, energy can become a break point for the economy if the prices go high enough. And we'll see what happens with market tightness. As API, we can't predict the prices. But more than $20 trillion worth of economic stimulus globally has had a very uplifting and positive impact on economic growth estimates. Historically, if we're looking at the Bloomberg consensus, the growth estimates globally, and even for the US for this year and next, are historically strong. So even if some of this recedes and it's not as strong as advertised, it's still historically strong and above average from an energy standpoint. So I'm pretty confident that we need more oil and more natural gas to enable the economy and the amount of growth that we're likely to see. And it's just a question of whether we'll have the enabling processes that will make the supply side catch up with demand.
Okay, well, that's certainly encouraging to hear, Dr. Foreman. I'm glad to hear that point of view from you. So let's wrap this up. And I thank you so much for being with us today. And we certainly look forward to reading your upcoming article in the next issue of BIC Magazine. So for more information and updates from API, visit api.org, where you can find Dr. Foreman's economic industry outlook, his blogs, and more. As always, we are most grateful for our audience. Please like and share this recording with colleagues, and for more industry news, videos, webinars, and podcasts, visit bicmagazine.com. And remember, it's what we do together that counts.